If you're a dividend investor, you probably love seeing a growing stream of income coming into your account on a regular basis. But what if I told you that not all dividends are created equal and you could be leaving money on the table? Good morning, everyone. Today's fiscal focus is all about dividends. There are two main types. The first kind is the most common, it's called a qualified dividend. Now, there's another type that's not qualified, it's called an ordinary dividend. I'm going to give you the rundown of some of the differences between the two, some examples of companies that pay each type, and a couple of different strategies to help you make the most out of each type of dividend. Qualified dividends are paid out generally by corporations that already pay the regular corporate tax rate on their net income. Companies like Apple, Coca-Cola, and Target are examples of companies that pay qualified dividends. When you personally receive a qualified dividend, you are also taxed at your long-term capital gains rate. This means they are subject to what's known as double taxation. Ordinary dividends, on the other hand, are paid out by mainly REITs and BDCs. This is because they have a special business structure that allows them to not pay in any corporate tax in exchange for distributing 90% of their otherwise taxable income out to shareholders. The trade off is that as a shareholder, when you receive these ordinary dividends, you actually get taxed at your ordinary income level. Get it? Ordinary dividends, ordinary income tax rate. Now, that may end up being slightly higher than the qualified dividend tax rate for individuals in most cases, but there are some strategies to mitigate this. Before we dive into those strategies, make sure you use consecutive normal punches on that like button and help us grow the channel. Now, I bet you're saying to yourself, those ordinary dividends don't sound so bad except for the fact that I have to pay my ordinary income tax rate. Wouldn't it be nice if there was a way to take advantage of the fact that they can return capital to you tax-free without then passing that tax burden essentially on to you? Well, there is one strategy, all right? So basically, it involves targeting those specific investments in your Roth IRA, all right? Because the Roth IRA is investing post-tax dollars. Now, there's a limit on how much you can put into a Roth IRA every year, so this isn't an infinite money glitch or anything. But if you were to specifically make your investments in these ordinary dividend payers in a Roth IRA, you can actually grow that money and that income tax-free until you retire. So you can take advantage of, a dividend reinvestment plan or whatever, and not have to pay any taxes along the way for decades at a time. Now, I think that's a pretty clever and strategic way to go about investing in these types of companies if they're the kind of companies you want to invest in the first place. Roth IRAs also provide the same exact advantage for qualified dividends as they do for ordinary dividends. So, yes, you could use the same strategy with your qualified dividend paying investments as well. There's one more strategy to be more efficient with your qualified dividends, and it's actually funny because Warren Buffett uses it. Warren Buffett, and more specifically his holding company Berkshire Hathaway, takes advantage of something called the dividends received deduction, where corporations effectively pay lower taxes on dividends they receive from other corporations. As you can see, the amount of the deduction is entirely dependent on the percentage of ownership that the receiving corporation has in the paying corporation. This is to avoid triple taxation. This is the reason why that while Berkshire doesn't pay a dividend themselves, Warren Buffett and his team at Berkshire don't shy away from buying dividend-paying companies in Berkshire's portfolio. Now, it's a little bit questionable for me to put this in here as a possible strategy. One would likely have to be a millionaire in order for this to even come close to being worth it for your own purposes. But hey, If you are a multimillionaire and you have a holding company and you want to have dividend paying stocks, it might make more sense to own them through your holding company more so than in an individual personal brokerage account. If you liked this video, make sure you drop a comment faster than The Undertaker dropped Mankind off the Hell in a Cell, and make sure you subscribe to the channel and catch us every Saturday night at 8 p.m. Eastern on Cashflow Kings Live.